Hello everyone, this is Dr. Ramishri MG, Assistant Professor of Commerce, Government First Grade College, Kumta. We'll discuss BCom 5th semester's Accounting Theory, Unit 5, Accounting Standards, Part 6, Accounting Standards Issued in India. This part includes Indian accounting standards, objectives of Indian accounting standards, list of Indian accounting standards, and detailed discussion on accounting standard 1, 2, 3, 4, 5, 6, 7, and 8. Indian accounting standards are converged standards for international financial reporting standards. These are popularly known as IND AS. Indian Accounting Standard provides principles for recognition, measurement, treatment, presentation, and disclosures of accounting transactions in financial statements prepared as per Indian Accounting Standard. The main objectives of Indian accounting standards are: this standard prescribes the basis for presentation of general purpose financial statements to ensure comparability both with the entities' financial statements of previous periods and with the financial statements of other entities. It sets out overall requirements for the presentation of financial statements, guidelines for their structure, and minimum requirements for their content. Indian Accounting Standards 32 are issued or amended by the Accounting Standards Board of Institute of Chartered Accountants of India to establish uniform standards for preparation of financial statements in accordance with Indian GAAP, generally accepted accounting practices, for better understanding of their users. ICAI has announced on 15th November 2016 that Accounting Standard 30, which reads for Financial Instruments Recognition and Measurement, Accounting Standard 31, Financial Instruments Representation, Accounting Standard 32, Financial Instruments Disclosures stands withdrawn. Now we'll understand Indian accounting standards from 1 to 8. The first part, Indian Accounting Standards 1, for disclosure of accounting policies. This accounting standard, issued in November 1979, is made mandatory in respect of the accounting periods commencing on or after April 1st, 1991 for companies and certain enterprises, and in respect of the accounting periods commencing on or after April 1st, 1993 for all the enterprises. This standard deals with the disclosure of significant accounting policies followed in preparing and presenting the financial statements of an enterprise. These significant policies should normally be disclosed in one place, and they should form part of such financial statements. Accounting Standard 2 deals with valuation of inventories. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 1999 and is mandatory in nature of inventories to be carried in the financial statements of an enterprise. This standard specifies that the inventories should be valued at the lower of cost and net realizable value. Cost of inventories should comprise all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to their present location and condition. The financial statements of an enterprise should disclose the accounting policies adopted in measuring the inventories, including the cost formula used and the total carrying amount of inventories and its classification appropriate to the enterprise. Accounting Standard 3 deals with cash flow statements. This accounting standard is revised in March 1997 and was recommendatory in nature and is made mandatory for enterprises specified in a note given at the end of Accounting Standard 29 in respect of the accounting periods commencing on or after April 1st, 2001. This standard deals with provision of information about the historical changes in cash and cash equivalents of an enterprise by means of a cash flow statement which classifies cash flows during the period from operating, investing, and financing activities. Accounting Standard 4 deals with contingencies and events occurring after the balance sheet date. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 1995 and is mandatory in nature for all enterprises. This standard deals with treatment of contingencies and events occurring after the balance sheet date but before the date on which the financial statements are duly approved. The term contingencies means an event which may or may not occur, and this will be known only on the happening of an event. These are two types of events, namely events which provide further evidence to show that they existed at the balance sheet date, and other events which indicated that they arose after the balance sheet date. The events which occur after the balance sheet date are the significant events, both favorable and unfavorable, that occur between the balance sheet date and the date on which the financial statements are approved by the competent authority. These two types of events are those events which provide further evidence of conditions that existed at the balance sheet date and those events which are indicative of conditions that arise after the balance sheet date. Accounting Standard 5 deals with net profit or loss for the period, prior period items, and changes in accounting policies. This accounting standard comes into effect in respect of the accounting periods commencing on or after April 1st, 1996 and is mandatory in nature for all companies. This standard deals with disclosure of certain items pertaining to net profit or loss for the current period, in addition to any other disclosures as may be required by other accounting standards, if any applicable to the enterprise. However, this disclosure should be made unless the transitional provisions of any other accounting standard requires Alternative disclosure in this regard on or after April 1st, 2001. Accounting Standard 6 deals with depreciation accounting. Depreciation has a significant effect in determining the financial position and the result of operations of an enterprise. The amount of depreciation to be provided is based on the historical cost or other amount substituted for historical cost of depreciable assets, expected useful life of the asset, and its estimated residual value. This accounting standard was issued by the Institute in the year 1995. Subsequently, based on the recommendation of the Accounting Standards Board, the Council of Institute commenced this standard on or after April 1st, 1995. Accounting Standard 7 deals with accounting for construction contracts. This accounting standard has become mandatory with effect from accounting period beginning on or after April 1st, 1991 to companies and certain other specified enterprises and is now applicable to all the enterprises with effect from the accounting periods commencing on or after April 1st, 2003. This standard is applicable to contracts extending for a period over one accounting period. This standard deals with accounting for construction contracts in the financial statements of enterprises undertaking such contracts are construction of bridges, dams, buildings, etc. The enterprise has to disclose the method used to determine the stage of completion of work in progress and the contract revenue recognized in the period. And Accounting Standard 8 deals with accounting for research and development. This accounting standard, which was issued in January 1985 and which was made mandatory in respect of the accounting periods commencing on or after April 1st, 1994, has been cancelled as it is withdrawn from the date of Accounting Standards 26 on intangible assets become mandatory for the concerned enterprises. Finally, these accounting standards are recommended by the Institute of Chartered Accountants of India and becomes applicable to entities only when central government notifies it. In this part, we discussed accounting standards 1, 2, 3, 4, 5, 6, 7 and 8. These are the references. Being good is good for business towards sustainable business. Thank you.